morning, everyone. Thank you for attending today. Excited to do our monthly webinar, give an update on the economy and the market. We'll just give a little bit of time for people to trickle in. We're going to hold the same format today. So basically, we'll go through the slides and have a good discussion. And then if you have questions, if you can drop them in the Q&A, you can just click on Q&A and type it in, and I would suggest you click anonymous unless you want your name to be known. And we will take those questions at the end of the webinar, time permitting. And as usual, we are recording this webinar, and so we'll make the link available to you after. All right, looks like most people are in, so we'll go ahead and get started. What we're talking about today is really getting an update on where we are with COVID, where is the economy overall in terms of its recovery, talking about the Fed, the stimulus bill that just passed, and then talking a little bit about the markets and the path forward. So it's been a very busy last year. From March 2020 to March 2021, basically around this time is when the market actually bottomed a year ago today, coincidentally. So all of our balance sheets, at least all of those on the call, are in a far better position today than they were a year ago, which is a reminder of the importance of continuing to think long term and being patient, even when we're in as stressful as the situation as we were in last year, where people were sick, people were dying, the economy was shutting down, and the market was in free fall. So much calmer time, but still, obviously, there's always going to be things to worry about, and we'll talk about some of the things that are keeping the market jittery right now. So an outline of what we're going to discuss today: what's happening with COVID, what's happening with the economy, what's happening with the markets, talk about some tips for an uncertain future and the path forward. So what's happening with COVID? We've seen a rapid acceleration in the number of vaccines that are being administered per day. This is actually was created, this slide, back in early March. And so today, the average number of vaccines being administered is actually closer to 2.5 million per day. And the percent of the US population that's been vaccinated is now up from 9.5% to closer to 13%. So the number of vaccines being administered every day continues to increase. And back in early March, President Biden said that we will have enough COVID vaccines, he predicts, by the end of May for every adult. Doesn't mean it'll be administered. Certainly that would be unlikely. But what the scientists have said is basically, in order to reach herd immunity, we have to get to about 70 to 80% of people being vaccinated. There's talk about that happening sometime mid to late summer, but certainly we're heading in the right direction. And Jamie from 4J actually just told us today he got registered today for his first COVID vaccine. So things are moving along nicely there. And luckily we've all stayed healthy, and we hope you all have as well. So this is a chart that JP Morgan put out, and it just shows the drop in cases and the drop in deaths that have occurred kind of since toward the end of January, or really end of February, where you can see this big drop off in number of confirmed cases and number of fatalities. We're certainly not out of the woods yet, but we're trending in the right direction. JP Morgan, not surprisingly, says if we can vaccinate those over 65, it's going to eliminate 80% of the people dying from COVID, because those are the people who are most at risk. But 2021 is still going to be a transitional year, and we still want to be as cautious as possible. But for the most part, most economists and doctors think by the third, fourth quarter we'll be back to a quote unquote normal post-COVID world. Okay, so obviously the economic trajectory is largely been following, the virus and how we've been able to contain the virus and the vaccination. So what President Biden ultimately got passed through the Senate in March 6th was a $1.9 trillion stimulus and vaccine program, which is of course not the first stimulus bill that's been passed since coronavirus started. This will put us close to almost 5 trillion between all the different packages that have been passed. And there's another one kind of on the horizon in terms of the infrastructure bill. So we'll talk about that. But basically, this was a big one. It passed March 6th. Big direct payments are already starting to hit people's bank accounts, but $1,400 was sent out to most Americans, anyone who had an adjusted gross income of less than 150,000, married, filing jointly, that is. And of course, this is above and beyond the 2,000 and the 600 that were received previously. So of the total 1.9 trillion, the biggest chunk of it is going to direct payments to Americans. That's 410 billion of the 1.9 trillion total. They also extended federal unemployment insurance through September of 2021, increased it to $300 per week. So that comprises $246 billion of the 1.9 trillion. Also, significant aid, 350 billion to state and local governments, part of it for schools, part of it for COVID testing, vaccination sites. In addition, there was some money that went to small businesses, a grant program, and a $35 billion low interest loans for early stage entrepreneurs, and then a pretty big, a sizable tax credit. Rather than the $2,000 per child, it was increased to $3,000 per child, up to those limits I mentioned. And that is fully refundable. So even if you don't owe taxes, you would actually get a refund based on the credit amount. So that's a very big deal for a lot of families, and hopefully will help a lot of families. And that costs another 143 billion. So again, the labor force overall is still hurting, and that was the whole idea behind the stimulus package. And part of what's keeping the market up at night, and we'll talk a little bit more about this, and a lot of economists, is just now with the amount of debt that's on our balance sheet. How are we going? How is this going to be managed? What is inflation going to look like? I mean, 2008, 2009, people were concerned, and the numbers that we're looking at now are just dwarfing what those deficit numbers were. And again, this is probably not the end. The additional spending is going to be focused on climate, infrastructure, and social programs. Biden has said that. He's made it very clear that's going to be his focus. In addition, expanding Medicare, the healthcare Medicare program, to those age 60 and up versus right now it's 65 and up, would greatly kind of increase the cost of Medicare. And regulation obviously is going to probably tick up, although it's going to be difficult to do through legislation. And then on the tax side, especially the estate tax side, Biden is looking to decrease the lifetime exemption. Right now, per person, it's 11.58 million. So for a family, 22 million. If you're below that amount, your estate's below that amount, your kids or grandkids won't see an estate tax. He's talking about dropping it to either 3.5 or 5 million, which, if it's 3.5, so 7 million total for families, it's still only going to affect the rich, but it's going to hit a lot more people than the $22 million level. And so it would be wise to kind of keep an eye on that. And then there's also been talk about abolishing the step up in basis at death. Right now, the way it works is if you pass away and you have a taxable asset where you paid $1,000 and it's worth $10,000, your heirs get to step up the value, the cost basis to the value as of the date of death. So if they were to go and sell that asset, their cost basis would be $10,000 versus the $1,000 you paid. Obviously, if that went away, there would be a much more significant amount of tax revenue that would go to the government. So when we talk about the American economy, the US economy, we will start with the Fed. So Jerome Powell, the Fed chairman, has been very clear that he has no intention of raising interest rates anytime in the near future. He's actually indicated not doing anything until 2023, 2024. And he basically said in his most recent speech that he gave last Monday that 10 million people lost their job during the pandemic, and we still have a long way to go before they all get reemployed. And so he's looking to basically getting the unemployment rate below 4%. And he actually is waiting for inflation to go well above 2%. It's about 1.5 to 1.6% right now as measured by CPI. So not only going above 2%, but actually sustaining that level above 2% for some time period. So, I mean, that's very supportive of the overall market. That's very similar to what the approach Bernanke took after the financial crisis. And that's going to keep at least the short end of the curve anchored to zero, which is going to be stimulative for stocks. It makes for quite a challenging environment in bonds, which we'll talk more about. But again, the idea here is to stimulate spending, to get businesses to rehire, to get the economy back up and running. And so that's his approach, their approach, and they've been very clear and they've reiterated time and time again. What's happening is, this is JP Morgan, basically what we're seeing here is while the Fed is keeping interest rates low, as the vaccinations continue to roll out, and the investors are looking forward, because that's what the market does, it looks forward to future demand and supply, is it's looking and saying, okay, we're going to be in a post-COVID world most likely in the second half of this year. And so you're seeing the 10-year treasury in particular rise. So whereas before kind of everything was basically close to zero, meaning the short end of the curve and the intermediate and long term, now you're seeing the Fed anchor at zero, but it's actually the curve is steepening. And so a steepening yield curve overall is a good sign, a sign of growth. What we're seeing in the market is that companies that really were big COVID losers, like the hotel industry, leisure, hospitality, financials, materials, energy, which just had abysmal performance in 2020, has really picked up steam in 2021 with the eyes on a recovery. So as of March 22nd, really even into today, the 10-year is at 1.68%. So, I mean, that is a very, this is a chart to give you some perspective. So this goes back about 3 years. So back in more normal times, if you want to call it that, right, the 10-year had risen all the way up to 3%, 2.5%, it had trended downward. Before COVID, it was almost 2%. And then it dropped, the 10-year dropped actually below 0.5% during the depths of when everything was shutting down completely. And then it kind of bottomed throughout most of last year and started trending upward, really accelerating once the vaccine was announced. And you can see how steep, right? I mean, this is showing you how quickly the 10-year treasury has risen just really since the beginning of this year. And so this is what's driving the volatility in the markets. It's obviously a big headwind for bonds because as interest rates rise, bonds go down. But still in aggregate, when we look at this, right, if you look historically, the 10-year treasury of even 2% is still very, very low and going to be supportive of risk assets because you still aren't really going to outpace inflation earning 2% on the 10-year bond. But nevertheless, the rapid change of the 10-year is what's making the market jittery. But overall, it is a sign of economic recovery. So some of the big Wall Street banks are naturally increasing their 2021 GDP estimates as the global recovery continues. This is really a 2021, a unique to 2021 thing where we're coming from such a low point. But if you look at the big banks, Goldman Sachs, Morgan Stanley, Bank of America, JP Morgan Chase, they're all projecting GDP growth in 2021 of anywhere between 6% and 7%, which obviously is a positive, and it's a sign of the economy reopening and people getting back to life as normal. So, that'll likely change a little bit as we go forward through the year. But my guess is, and our assumption is as we go into 2022, that's going to revert back to the 2 to 3% kind of real growth rate that we have been experiencing, prior to COVID. So this is kind of an anomaly of a year because we're coming from such low levels. The economy, just for perspective, in 2020 as a whole contracted, so it shrunk 4% in 2020. So obviously with the economy, other than stimulus spending and the Fed, we also have to look at the labor force. So there's going to be a long recovery, probably not as long as 08, 09, because that was more of a structural thing, but nevertheless, the world has changed and it's probably not going to go back completely to the way it was before. You can see here through end of February 20th, 2021, approximately 4.3 million Americans filed continuing unemployment claims. You can see going back to March, just how, or excuse me, back to May, June, right? You had just massive numbers of unemployment claims being filed. So just to give you a little bit of perspective, I think this is a helpful chart, just gives you a history of unemployment levels going back to 2000. So as you can see here, right, through the .com, you saw a rise in unemployment and then it gradually ticked back down. You saw a big rise in unemployment during the great financial crisis, right? And that gradually trended down very gradually over time, right? It was slow before we got back to kind of full employment, which basically happened in 1920. And then of course, look at this. This gives you a sense of just the magnitude of the crisis. I mean, basically overnight, you went from full employment to essentially what looks like, you know, a Great Depression. And then you've seen kind of a more rapid recovery where people have been hiring since then. But our guess is this is now going to kind of slow down a little bit more to what you saw after post 08, 09. And so the rate of that recovery is going to be obviously a driver. So consumer sentiment and mortgage activity have gotten better, but recently have fallen. Mortgage activity has fallen because as the 10-year treasury goes up, mortgage rates go up. So last year was a great year to refinance, and still, again, rates are low, but from relative to where they were 3 months ago, not nearly as attractive. And then another big thing we'll talk about here, personal savings rates, which we'll spend a decent amount of time on, and then, you know, construction spending. Personal savings rates, I mean, this is pretty amazing, but if you go back, like if you look at personal savings rate going back to 2016, because of the fiscal stimulus, right, the checks that went out, most of that money, because people couldn't go anywhere, just ended up in their bank accounts. So personal savings rate rose to 20.5% in January, up from 13.4% in December of 2020. So you're seeing that you had a surge here, and then you have another surge here. And then this doesn't even include the 1.9 trillion where that was just essentially just sent out, or, you know, a portion of it was sent out to individuals. So you have a lot of money, trillions of dollars that's sitting in people's bank accounts, and they can either invest that in the stock market, they can, you know, buy assets or go out and spend it. But from surveys, a decent number of those have said, you know, about 40% of that money they plan to invest in the stock market. And a lot of these are millennials who have been making money. So just something to keep in mind. Construction spending is through the roof. U.S. construction spending rose 1.9% in January, up to an annualized pace of 1.5 trillion. This is the highest level the government has seen since they began tracking it in 2002. So, right, people, low mortgage rates, Fed's holding rates low, very, very low mortgage rates. People, the kind of the tier 1 and tier 2 employees have retained their jobs, and, you know, they're buying, they can afford a bigger home. And so they're moving and they're spending that money. And so that's what's driving this. Kind of have almost like two different economies. So what's happening with the markets as a result of all this? There's a lot of rapid change that's occurring in the world as a result of COVID. And then, you know, what's happening with interest rates. And so the markets are reacting very quickly to that. So this goes back. So we have a couple things we're looking at here. The chart here shows you year to date the performance of 3 major indices in the United States: the NASDAQ, the Dow Jones Industrial Average, and the S&P 500 Index. And so if you look here from the beginning of the year, the NASDAQ is up about 1.54%. The S&P 500 in blue is up 4.91%. And the Dow Jones Industrial Average is up 6.94%. But again, this is only going back not even 3 months. But what you're seeing here is the industrials, financials, and energy are carrying the market higher, whereas the NASDAQ, which is much more technology focused, has lagged kind of the overall market. But perspective is everything, right? So year to date, those are the returns, but over the last 1 year, so going back essentially to the bottom a year ago, the S&P 500 has risen almost 71% from its low. The NASDAQ in comparison has risen 87%. So, right, a pretty big increase relative to the S&P 500, 17% higher. So technology, even with lagging over the last 3 months, the NASDAQ has greatly outperformed the S&P, and the Dow Jones has finally caught up to the S&P 500, up just shy of 71% year over year. So again, it's kind of timely that we're doing this webinar today because it marks the 1 year anniversary of the market low. And as you can see, right, patience again did pay off, where if you were patient and didn't sell, we've seen a huge increase in the price of assets, particularly stocks during that time frame, but not just stocks, right? Real estate as well has appreciated nicely during this time frame. So when we look at earnings season, which is essentially now complete, but as of March 2nd, 97% of the S&P 500 companies have reported their Q4 2020 earnings. Kind of amazing. According to FactSet, the blended earnings growth rate for 2020 was actually 3.9% positive. In addition, almost 80% of the firms beat earnings expectations, which is the fourth highest beat rate since 2008, going back to the great financial crisis. And there's an expectation that earnings will grow about 21% in Q1 2021. Obviously, with everything that's happening, we're accelerating into 2021, the economy reopening. That's what's fueling that. But just to contrast it and make sure you're aware, because a lot of people are still confused the two, but remember, GDP, the gross domestic product, last year contracted 4%, right? So the economy actually got smaller from January 1st, 2020 to December 31st, 2020. But earnings, okay, which is really what the market is ultimately gonna move in tandem with, grew 4%. So that's an 8% spread. And there are a number of reasons for that. But remember, 2/3 of GDP is measured by consumer spending, consumption, which obviously people weren't really spending last year because they were stuck at home. Whereas the S&P 500, right, the market is not driven 2/3 by consumer spending. It's driven in a large part by manufacturing. 40% of the revenues of the S&P 500 actually come from overseas. And in addition, you have a situation where the overall economy is more and more comprised of companies that have a digital footprint. Think, Netflix or Zoom or Amazon or Google or Facebook, right? We're on Zoom right now. So those companies and the companies that already comprise a bigger portion of the S&P 500, frankly, were already fairly well positioned for kind of the acceleration of the digital economy, which is exactly what happened. And so that I think explains a lot of the disparity. And really, if you look here at the underlying sectors in the market, energy and industrials, which by the way, year to date are leading the way. But last year, right, you saw huge negative, right? Essentially, energy was down almost 100%, and industrials were down 50%, because industrials are very tied to aviation, right, air travel, things of that nature. So pretty stunning to see that, and maybe eye-opening for some of you. In terms of, we look at the S&P 500, we've talked a lot about this, and we're not saying concentration risk remains high and that we're concerned about it. But it is important to understand that the way that our economy, the way that the market has evolved over the last 10 years is a greater and greater portion of software companies, which are Google, Facebook, Microsoft, Amazon. They were already big and then they got bigger, which is why they're all kind of in the antitrust crosshairs now. But basically the top 10 companies, the S&P 500, account for 28% of the entire market capitalization, right? So the top 10 are doing most of the work, or at least about a third of the work. And in addition, those top 10 stocks are contributing about 26% of the total earnings of the S&P 500. So, people are comparing this environment to the tech bubble of 08, 09, and we don't think it's comparable to that, because the companies, that I just mentioned, the Amazons, the Googles, the Microsofts, and, the Facebooks, dare I say it, they are growing faster. They're more profitable, Apple, and they just have the benefit of being software driven and having tremendous network effects, where the more people that become part of that ecosystem, the more valuable that business is. So just wanted to make that point that is a big part of the S&P 500. We don't see that really changing materially anytime soon. So something to keep an eye on. What's happening now is the stock market growth, right? What kind of propelled the market in 2020, largely led by growth and technology, is now broadening out, right? It's broadening out to small companies or small caps and value-oriented stocks. So you can see here, year to date, value-oriented investments, large through small, are greatly outperforming growth. If we go back over the last 10 years, though, you can see this is our per annum growth has greatly outperformed value. Okay, and same across the board in mid caps and small caps. And value, just when you think value, think things like financials, materials, energy, utilities. Growth, you can think technology, healthcare. Now, to some extent, these terms can kind of migrate from one to the other. There are companies like Apple, which were deemed a growth company 5 years ago, which a lot of people now would say is more like a value company, or Microsoft. Okay, so you have to be a little bit careful with these terms, but the idea that companies that have enabled or are software enabled, have the ability to scale without the same cost as something like a manufacturing company, or a company that needs to actually build a new plant. Those are the companies that have been able to grow at a much higher rate than value. And you're seeing this kind of revert back to the mean, which is a sign, I think, of a deepening and broadening bull market. So just something to be aware of. We are keeping an eye on it. We do think value makes sense go through this recovery. But again, we think kind of come mid 2021, towards the end of 2021, Wall Street and analysts are going to start saying, okay, well, what are the earnings growth expectations over the next 1 year, 2 year, 3 years? And as long as interest rates stay low, it's hard to imagine that some of the companies that are doing so well right now, kind of coming back to normal, are going to be able to sustain that pace. And so the question is, at what point does that transition happen back again? But anyway, that's what we're looking at. So fixed income, commodities, cryptocurrencies, all things we probably didn't talk about in 2019, at least on the cryptocurrency. So one of the things that it can be a good sign as to the health of the market and just overall credit risk is to look at the bond market. Bond spreads are considered a canary in the coal mine sometimes, which means that basically the lower the spread between corporate bonds and treasuries, the lower the risk in the overall economy and the overall markets. And right now, the spread, as you can see here, is pretty much at an all-time low. And so bond market saying, and it makes sense because the Fed has essentially said, we're going to backstop anything and everything, right? The Fed and the Treasury have said, you know, we're not going to let anything fail. And so as a result, the market's basically saying, okay, we're not going to price in any risk there. So that's what's being reflected. Bitcoin, you probably have heard about it, read about it. You know, maybe you understand it, maybe you don't. It's certainly not an easy thing to wrap your head around. But basically, I think the easiest way to think about it is the government, governments around the world are in huge amounts of debt. And I think since the great financial crisis, more and more people have been frustrated with the financial system. And they've been frustrated where in order to pay for something, you know, the banks or the credit card companies kind of take a cut of that. Even if it's 1 to 3%, they take a cut of it. And so as a result, you've had technology that's emerged. Really, this Bitcoin started back in 2008, which essentially uses computers and networks to allow the transaction of a good or a service, and it's essentially in an open ledger format. So all of these different computers around the world through blockchain technology can confirm or agree and say, yes, this is a valid transaction or it's not. And the reason, you know, like anything, some of this is based on faith versus just intrinsic value. But you know, the benefit is that there is no middleman to take a cut. Okay, and so as this technology has grown, Bitcoin's kind of been the poster child for it. There's been a wider adoptance and acceptance, and COVID and just kind of the move to digital and millennials getting much more involved in the market has driven kind of Bitcoin up. But interestingly, as amorphous as the valuation is, you know, very hard to really understand why it's worth what it's worth. You're seeing more and more institutions. You're seeing places like Mass Mutual, you know, corporations, Square, Tesla, MicroStrategy. You're seeing big institutions. JP Morgan, BlackRock have mentioned they're dabbling in it. You're seeing big institutions take positions in Bitcoin, and then they're holding them. They're not selling them. And so, you know, it's almost like a flywheel effect. The more that people invest in it, the more they believe in it, the more it actually has value. I know that seems crazy because intrinsically it doesn't actually have any value, but nevertheless, it hit an all-time high of 58,330 in February 21st. It fell off 15%. It's now back to about 55,000, at least when I last looked. It can be very volatile. But it is something that we're keeping an eye on, because even though it doesn't pay anything, when you look at the state of interest rates and the bond market, you know, if inflation does go up to north of 2%, it's called, you know, 2.5–3%, and yields, treasuries are yielding 2% or 2.5%, you're essentially getting a negative return after factoring in inflation. And so we continue to evaluate whether, as a portion of the overall portfolio, very small, does it make sense from an asset allocation standpoint? And certainly for some people, it never will. They don't want us to touch it, and we understand that. But others more and more have been asking us about it. And so just to make the point, we're aware of it, we track it closely, and we're constantly reading about it. So, you know, it's Bitcoin, Ethereum, all these cryptocurrencies. It's a trend we don't think is going away. And so, you know, we're not going to just turn a blind eye to it. Okay, so obviously the future is uncertain. One of the things that we've been talking to all of you about is low tax rates, and the fact that it's just very unlikely that is sustainable as we look forward over the next 10 and 20 years. You can see here at the chart on the top right, and this was before this most recent spending bill was passed, but the amount of the fiscal deficit is on par with that of World War I and World War II, right? Remember in 2008, 2009, we had a huge, right? It was essentially the biggest amount the government spent since World War II. Well, of course, COVID has made that look, like peanuts in comparison. So obviously, there's only a couple different ways the government can that we can all pay for this. One is through inflation, right? So the cost of things go up, so the money's worth less over time. Or two, through increased taxes over time. Right now, going into the Biden administration, ordinary income taxes and capital gains taxes are actually at some of their lowest levels historically. Now, some of you are going to know that going back to the 50s and 60s, yeah, the tax rates were higher, but there's a lot more deductions. Nevertheless, it's not realistic for these tax rates these marginal rates to last over the next 10, 20 years. They're just going to have to go up because the government's going to need to find that revenue somewhere. So Biden's already talking about it. It's very, very likely going to happen later in the year, going into 2022. Hopefully he doesn't make it retroactive. Maybe he does. So we'll see how it all plays out. But big picture is, and again, this does not mean you should run out and try to sell everything to get tax rates. Now, this is all dependent on your individual situation, but from a broad aggregate standpoint, the trend is tax rates are going to be going up in our opinion. That's what we think. A couple planning ideas, things to consider. To review, we try to do a good job in being thorough of doing this with you all during your reviews, but obviously consistently reevaluating your beneficiaries on your IRAs and your inherited IRAs, right? The idea there being when you pass away and your kids get the IRA, they only have essentially 10 years to take that money out. So one, making sure the beneficiary that you have listed is correct, but also starting to talk potentially with your kids or heirs about, hey, this is how the rules work. They're probably not going to know that they have 10 years to take it out and even what that means. So having that open dialogue with them can be actually very helpful. Two, engaging in active tax bracket management. One of the things we talk about a lot with you guys is after you retire, but before Social Security and your requirement of distributions come in, the opportunity to convert, we talked about it here, pieces of your IRA into a Roth, kind of micro conversions. And that could still make a lot of sense for many of you during what we call those gap years. You may even want to increase income in low tax years by taking money out of the IRA or selling stocks that have appreciated a lot, so they have a high embedded capital gain. If you have life insurance in force, remember, life insurance, when you pass away, it's tax-free, income tax-free to the beneficiaries. So it can be an effective way to either help pay some of the taxes or to replace the lost value of an IRA due to taxes. And if you are charitably inclined, doing things like charitable remainder trusts or making charities the beneficiaries of the IRAs and leaving money outside the IRAs to your heirs is a more effective way to do it from a tax perspective. So again, these are things we've talked about with all of you over the years, and we will continue to. So hopefully nothing too new here, but again, it all depends on your particular circumstances and situation. So again, these are all estimates. BlackRock, we pulled this from BlackRock. These are 5-year annualized estimated returns and uncertainty based on the various asset classes. The reality is Vanguard, BlackRock, American, all these big institutions going back to 2010 were saying equities were only going to return, 5 to 7% per year over the next 10 years. And of course, equities have returned much, much more than that. So it's again, these are estimates, take them for what they will. But basically, I think the big picture takeaway here is stocks are still going to be one of the few asset classes that have a strong likelihood over a long period of time to outperform inflation. Bonds, particularly kind of treasury bonds, investment grade bonds, things like that are considered low risk, they may actually have a negative return after factoring in for inflation. So we have a really challenging environment in fixed income going forward. That doesn't mean you abandon bonds completely, but it does mean that I think we have to be a little bit more active and creative in terms of how we approach, the fixed income portion, that kind of 7 to 10 year bucket of money that we don't want in the stock market. We have to be thoughtful about not just putting that into, treasuries and corporates and saying, okay, that's it, because the forward returns on those based on where rates are just not, not at all attractive. So again, your typical 60-40 portfolio, 60% stock, 40% bonds is under pressure because a good example of that is year-to-date bonds, right? People say, oh, stocks are up 3, 4, 5%. Well, bonds are actually down. The Barclays Aggregate Bond Index is down 3.5%. So if you're in a 60-40, you might only be up 1 to 2% year to date. And again, if you look back last year, you were still at double digits. But going forward, right? It's always about going forward. What are we going to do? That traditional 60-40 model, we need to make sure we're thinking creatively. And so some ideas that we've been implementing are, rather than just in traditional bonds, we've looked at things like treasury inflation protected securities, high yield bonds, especially with credit risk being as low as it is, looking overseas to some emerging market bonds, floating rate bonds, where the floating rate loans, rather, where the loans are tied to essentially LIBOR, where if rates go up, essentially the payment from the company to the bank would actually go up. And then, looking at potential exposure to things like commodities, gold, hedged equity. Hedged equity just means, rather than taking the full risk of an S&P 500 index fund, we have a hedged exposure where it captures 60% of it to the upside, but the first 10% to the downside, you're not participating. Something like that, where you're not investing in bonds, but in order to kind of not have the same one-for-one exposure to the stock market, you're giving up some upside for downside protection. Kind of talked about these multi-sector, not looking at bonds through a little bit more of a wide lens as opposed to just treasuries and investment grade corporates. So these are all just different ideas. Again, the market has and always will climb a wall of worry. The worry, look, the market's up 70 to 80% US market from the bottom of last year. It was a tragic year, a lot of struggle, a lot of people died, very, very sad. The market is kind of cold that way. It doesn't necessarily, right? It's just looking at the numbers. And so we wrote a piece on this about the market climbing a wall of worry, but it has and it always will. And to some extent, worry in the market and volatility in the market is healthy. When the market's just going up in a straight line like it did, from April to end of the year, I think it was a matter of time before we saw some sort of correction. So just something to keep in mind. And timing the market, again, can be a very enticing thing to do, but we always encourage clients when they talk to us and they say, look, I remember vividly conversations from last year with some clients, not many, but sometimes just said, I can't, the world looks like it's going to end. I don't want to be along for the ride. And so, despite our pleading and trying to kind of explain, look, we have a portion of the portfolio that can be there for you, that is designed to get us through these types of periods, they just didn't want to deal with it. And so, if you end up selling during those time periods, anywhere in here, it's very, very hard, one, to get back in, and then two, if you look at the trend of the market, the biggest growth was this first part here, right? And by July, by August 10th, this is one of the fastest recoveries. The market peaked February 19th, bottomed a year ago today. and it had fully recovered by August 10th. So that doesn't tell you it's hard to time the market. I don't know what does. I mean, that's unbelievable. So the S&P going back 20 years, basically from the peak of the market before, has done 6% per annum. More recently, it's done, about 10% per annum for the last 10 years. Investors who stayed invested in the S&P 500 or in bonds beat inflation by 3.9% and 2.8% respectively. The typical investor, the average investor, did only 2.5%. And it's not because there's an old saying, the market is not the problem, investors are the problem, right? Because from a behavioral standpoint, it's just so hard to maintain that long-term perspective, I'll say, when things are, there's so much fear in the world and in the market, and people are seeing their accounts go down, a huge amount in a short period of time. So we understand, we don't like to see the accounts go down either. Hopefully it gives you peace of mind that during those time periods, I certainly am not sleeping very much at all. So we do everything possible to mitigate those, but we also recognize that in order to be successful, we have to experience, in order to get those returns, right, that we're trying to get, there's going to be some level of volatility that we just have to accept. And the good news is that over long periods of time, it tends to work out quite well. So buy low, sell high, right? The common investment mantra, buy low, sell high, it gets a lot more complicated when emotions are involved. It's simple. It is the hardest thing in the world to do. So this just goes through attempting to time the market. If you stayed fully invested from 2004 through the end of 19, you would have achieved 10,000, would have turned into 36,000. If you missed only the 10 best days, you would have reduced your return to more than half, to 4% per annum. You missed the 20 best days, you reduced it to 1%. 30 best days, you actually had a negative return, and missed 40 best days, even more negative return. You'd be surprised how many people end up falling into one of these categories above the top, because it's just so hard emotionally to see your accounts go down when the market's going down. So again, we'll finish with this and we'll take some questions. This is going back from 1950, and this is the idea of this is to show you the importance of having that long time horizon. 1950 to 2020, the green is an all stock portfolio. The bonds are a 100% bond portfolio, and 50-50 portfolio is 50% stocks, 50% bonds. So over 1 year, if you're in all stocks, it's basically a toss up, right? Half the time, essentially, you would have been down, half the time you'd be up. In the worst case scenario, you would have been down 39%. Best case scenario, you're up 47%, okay? Now, looking at 5-year rolling, the worst return you would have had over all those 5-year rolling periods, so 1950 to 55, 51 to 56, 52 to 57, was negative 3% per year. So not good, but you can see the best was 28% per annum, and the majority of the time, 80+% of the time, you had a positive return. Over a 10-year rolling period, your worst possible return was negative 1% per year. Your best return was 19% per year, again, over 10 years. And 85 to 90+% of the time, you had a positive return. And over 20-year rolling periods, there was never a time over from 1950 to 2020 where you had a negative return. And in fact, the 1999 to 2019 was the worst performing 20-year period at 6% per year. You can see that here, right? That was the worst, was 6% per year. The best was 17% per year. And then you can go, right, bonds, you're positive year by year a lot more often. But if you look over the long term, right, you end up with a lower return. And a 50-50s, right, it's in between. So same old story, it doesn't change, but our behavior also doesn't change, which is why you see the disparity in the results, and why you'll always have market bubbles and bear markets. So, conclusion, it's important to know what's going on. It's important to know why interest rates are moving. Why is the NASDAQ trailing the Dow year to date? What's happening with the market? What's happening with the overall economy? The most important thing is to remember that when you're investing, your money, right, is the time horizon of that money is 10. Some of it's for that 1 to 3 years. Some of it's for 3 to 10 years, but the majority of it is for that 10+ year time horizon. And if you've gone through the plan with us, that through your financial plan, we'll continue to iterate that because that's how wealth is accumulated. So thank you so much. We have 10 minutes. We love doing these webinars. I do have one quick poll to ask because we had some different requests. So if you could answer this, basically is 11 a.m. on Tuesday a convenient time for the monthly webinar? Would you prefer to have it changed? Okay. All right. Thank you very much for those of you who have answered, which is basically everyone. I think we have our answer there. Thank you. Sounds like it is a convenient time. All right. I think Jamie is on as well. I am going to look at some of the questions, or it looks like people put the questions in the chat box. Is that right, Jamie? Did you already answer all the questions?
I did, yeah. There's one kind of simple question, and that participant's currently left. Okay.
Any other questions that anybody has on slides, what we discussed? We have 9 minutes. If you have them, great. If not, that's fine too. Probably was like drinking from a fire hose. We tried to make sure this was we packed the information in here to cover everything. Any questions? I know some of you have questions because I know who's on here, but that's okay. If you don't want to ask, that's okay too. All right. Doesn't look like there's any questions, so we will wait. Maybe we have one here. Hold on. Oh, thank you. Appreciate that. Yeah, so doesn't look like there's any questions. So if you have questions that you want to ask individually, you can email us. And we're grateful to be doing these webinars, and thank you so much for everyone who attended, and we'll see you next time. Bye-bye.